I'm going to show you how to pay less tax. We're going to talk about inheritance taxes and how to reduce your inheritance tax position. Now, I understand most people buy property because they want to build a legacy. They want to protect themselves. They want to protect their family. So it's important to understand how to keep as much of what you've built as safe and secure as possible. So in this video, we're going to explore a tool which causes a lot of confusion and how you can use that tool called trusts to protect yourself and your family against inheritance taxes. So in this video, I'm going to break down what a trust is, how to use it, specifics more around property trusts, and maybe the things that you have to know in order to protect yourself and your assets, of course. So a trust is a legal arrangement where one or more people, these are what we call trustees, hold assets. It could be money, property, valuables, land, for the benefit of others. That's important. Trustee holds assets for someone else. And this someone else is what we call a beneficiary. This is the person that's going to benefit and gain some form of access to those assets. The person that creates the trust is what we call a settler. So the trustee legally owns the asset. This is important, but they must manage those assets based on the rules in the trust deed, and they have a fiduciary duty to the beneficiaries. So it's not as if you say, "Oi mate, can you look after my house, and when my kids turn 21, give it to them." No, there are very, very specific rules, not written on a napkin, not written over a pint. There are very, very specific rules that detail what the trustee has to do to fulfill your desires with regards to your beneficiaries. So trust can be set up while you are alive, and this is something you should definitely explore, or it can be set up in your will. This is called testamentary. The reason why you hear wealthy people talking about trusts is because a trust creates a separate ownership, a separate legal ownership from beneficial ownership. That is the distinction. It's not that people are avoiding taxes. It's a matter of ownership. You pay tax based on ownership, but a trust effectively splits the usage of the asset versus the ownership of the asset. Therefore, once it's passed to someone, because they don't own it, but they have access to it, their tax obligations are completely different. You or your family can still benefit from assets that are held in a trust, but the legal title are held by the trustees. These are people you trust and you appoint and you empower to uphold the rules in the trust. So there are 4 different types of trust, and we're going to explore every single one of them. So why would it make sense for you to understand trust? Now, you might not be ready to set one up, which is fine, because of course you've got to own assets to set one up. Makes no sense because there are costs to setting it up if you don't have any assets to throw inside. But it's good to understand this. There are 3 main reasons investors and property owners set up trust. Number 1 is protection. If you hold everything in your personal name, you're exposed. You are at risk. One lawsuit, divorce, a business deal goes wrong, your assets are exposed. You as the individual are liable, so are your assets. But if a property is owned within a well-structured trust, it's legally separated from you. This is you, this is your assets. If you're in trouble, your assets are not in trouble because they are owned separately. Number 2, taxes and inheritance planning. Without planning, your family could effectively lose around 40% of your estate due to inheritance tax when you die. So my question is, how does it make sense to work extremely hard all your life, pass away, and technically steal 40% from your family when that could have been mitigated or reduced significantly by setting up something like a trust? There is no point working hard and not protecting those assets. Part of wealth is the protection of your assets. So by moving your assets into a trust, you remove those assets from your taxable estate, but you can still control them as a trustee. This is how the rich, the wealthy, the powerful pass down assets from generation to generation, but more importantly, tax efficiently. So I want to show you the 4 different types of trust that you can consider. Now, of course, this is not financial advice. This is just to educate you on what your options are. Number 1 is what we call a bare trust, B-A-R-E trust. Some people might refer to it as a simple or nominee trust. This is one of the most straightforward trusts, and you might actually already have one without realizing. A bare trust is when a trustee holds a property for the benefit of someone else, but the beneficiary has full access to it. So for example, if you were to buy a property in your personal name, but it's actually owned by your limited company, or you're holding that asset for your child when they turn 18, that is a bare trust, because all income and capital gains are taxed in the hands of the beneficial owner, not the trustee. So if your company is the beneficiary, it's taxed as corporate income, not personal income. It's pretty simple to set up. And this is what we see a lot of property investors utilizing, especially property investors with multiple assets. Number two, this is called a discretionary trust. This is often for the bigger players, but it shouldn't stop anyone from understanding this. A discretionary trust gives the trustees full control over who benefits, when they benefit, and how much. You set the rules, but you leave flexibility aside for the future. For example, let's say you built up a £2 million property portfolio. You don't want your 18-year-old you don't want your 18-year-old who's still sitting there playing PlayStation, showing no signs of maturity, who's likely to squander this. You don't want them having access. We've seen the data. These young kids get a lot of money, they blow it, they become drug addicts, and it's your fault because you gave them money. So you can create a discretionary trust where you or your solicitor or your accountant act as the trustees. Your kids are added on or listed as beneficiaries. The trustee can then decide when your child grows a beard, maybe when your child matures, or when your child decides that they are responsible, then the trustee can release income to your child or sell the property on behalf of your child, keeping control within the family. Discretionary trusts work really well, and I'm not promoting divorce, of course, but it works really well to protect against things like divorce, because we all fall in love at one point and we are sold this, fairy tale of romance. Oh God, I sound like I've been hurt, but you get my point. Let's move on. Number three, the life interest trust. So it's also known as interest in possession. A life interest trust lets one person, called a life tenant, benefit from the property during their lifetime. Usually it means they can live in the property, they can collect rent from the property, they get to benefit from it. Let me try and give you an example. Let's say you own a property worth £500,000. You want your spouse to always have a house. You want your spouse to live in that property and they can stay there for life. But eventually that property goes to your kids. So you would set up a life interest trust. Your spouse can live in the property rent-free for the rest of her life or his life, but they can't sell it and they can't leave it to someone else. And when they pass away, the house goes to the next beneficiary, automatically transfers to your kids. No probates involved, no legals involved, no argument. It's you get to use this for the meantime while you are alive. When you pass away, it goes down to the next person. Look, trusts are not necessarily the easiest things to understand, and it's not really for you to understand, but it's for you to understand what your situation is, what your goals are, and what your desires are. Then you've got to choose the right sort of trust with your solicitor. Then you should draft out a trust deed which gives power to the trustees. Then you transfer the property into a trust using a TR1 form, and this must be registered with land registry. This is mandatory. But it's important to say this: before you do anything, before you transfer anything, get some advice on what your stamp duty position would be, what your capital gains tax position would be, and what your inheritance tax position is likely to be. You don't want to trigger additional taxes because you're trying to save taxes. This is how the rich, the famous, the powerful pay little to zero inheritance taxes. Hey guys, I hope you get some value from this video. I'd love to hear your thoughts in the comment section. What do you think about trust? Do you have a trust? Are you thinking about setting up a trust? Very specific goals are.